Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is repeat offender and multifamily syndicator, Michael Becker. Now, Michael is a principal at SPI Advisory LLC and heads SPI's Dallas, Texas office, where he oversees all aspects of property operations, including asset management, property management oversight, accounting and taxation, capital improvement and renovation projects, and investor relations. Michael's a 15-year veteran commercial real estate banker and has originated and managed numerous portfolios of permanent and bridge loans in all major asset classes. So guys, without further ado, I'd like to welcome back Michael Becker to the show. Michael, how you doing, my friend?
Yeah, I've been doing pretty good. So what a difference a year makes, huh?
I know. It's crazy. That's funny. I actually remember where we were when we had our last conversation. It literally was May last year, so I forget the exact date, but it was just damn near a year ago that we had this conversation. We were a couple months into the COVID craziness, and we were kind of wondering what was going to happen, how this was ultimately going to play out. I know that, folks in your industry, folks in my industry, folks probably in the retail industry and the senior care industry, all that, like, lost sleep for a couple months in a row, wondering if they were going to receive their rents that coming month, right? Like first it was April and then it was May, and, just, we wanted to see, no one knew what was going to happen. And we probably got a lot more gray hair. Some people went balder than others, but in any event, I think that, multifamily and mobile home parks where we're at today, and even a lot of the other commercial asset classes fared much better than folks anticipated. And so we'd love to just, maybe from your perspective, again, it was very doom and gloom. It was very doom and gloom last May when we chatted, again, not knowing exactly how long it was going to last, just really any negative fallout that might have come from it. And we might not have even seen what that is yet today. It could still come, months or years down the road. But in any event, I'd love to get your perspective as to, really how you thought things were going to go to really how they went. Just kind of give us a recap of how your business played out over this last year.
Yeah, I mean, by the time we talked, I think the worst of my dark thoughts in my head were probably behind us about May. But, end of March, it was like, yeah, what are we going to collect 50% of our rent? And how am I going to, give all these properties back to the bank? And, some dark thoughts were going through my head at the time. And it turned out to be, largely a non-event from a collection standpoint. I mean, we would historically have kind of a little bit less than 1% delinquency. So, we collect over 99% of what we bill and, have less than 1% delinquency. And I got as high as, say, 5% delinquent in, say, December of last year, which is historically the highest delinquency month anyways, with Christmas and people buying gifts for the kids instead of paying rent. And then, we're now back to pretty close to normal. We've been carrying some larger delinquent balances and with the recent in December, and then I can't remember when they passed the most recent act, but they added some rent relief money and the last two big stimulus bills that the government passed, and that money finally started to flow in Texas, and we're starting to kind of collect that. So, we bill six something million a month, and we had probably 600,000 that had aggregated over the last, say, 12 months and delinquent rent. So, 72 million a year, 600,000 is a relatively nominal amount of money to kind of accumulate. And then of that, we're probably going to collect 450 of that through the stimulus money. Yeah. So maybe 200,000 that might kind of just go away for people that otherwise would have been evicted a little quicker. Mm-hmm. So, in the grand scheme of things, losing 200 grand and great, but it's really not that big a deal into 72 million. So operationally, I mean, it certainly caused a bunch of changes and challenges and things we had to get over. But, you're going to look back on this thing in a few years as kind of a minor blip on the radar screen from a operational standpoint, to be honest with you.
I agree. So things really went better for the most part. Things went better than anticipated. Rent collection, materially, all the above. Yeah. Are there any things that went worse than planned?
Just kind of losing a lot of sleep and stress and things like that. Nothing really went materially worse. I mean, I think everything. Of course, like I said, my head went to a pretty dark space there for a matter of a couple of weeks. So it was kind of doom and gloom, worst case scenario in my head there for a couple of weeks. So the bar was pretty low. So we cleared it by quite a margin. So I mean, just really proud about the way the overall team had kind of stepped up, and it's proud about how we kept the lines of communication open to all the investors, all the different stakeholders along the way. we opened up and before the government money started flowing, we internally did a rent relief fund and funded, 6 figures out of our own pocket to kind of help give some of these residents some assistance, really starting, I think, about June all the way through December till the government money kind of kicked in, where we pay for a portion of the rent and they can apply based off a deed. So where there was a gap, we kind of try to fill that internally. So I thought that
Yeah,
was
that's great.
something I was proud of internally as well. So it was a good challenge of our business model, and guys like you and I who provide affordable housing and safe and affordable housing, that really kind of proves out the thesis of our investment really
Yeah.
at the end of the day. So I think anyone that was an investor with us or thinking about the space should probably be even more bullish about how it reacted. And when we were tested, because it's been a decade or better before the last time anyone was really tested materially in the
Mhm.
space, and it really was pretty resilient.
Yeah, no, I agree with you. And one of the other challenges I'd love to speak to coming out of this pandemic that I don't think anyone really saw coming. Maybe they did, but is the challenge as business start opening back up is the challenge of getting these businesses restaffed. Even in the construction world, you and I both deal with lots of construction workers, staffing of our properties, what have you. Finding quality staff has been quite a challenge in certain markets that we're located in, not all of them, but finding quality staffing for on-site type projects, but also contractors have been an absolute nightmare to find. Quality contractors. Have you guys experienced the same challenges there in Texas, or are you
Yeah,
just
for
chugging
for
along?
sure. I mean, it's in particular on the maintenance side. I mean, that's those guys getting poached left or right to go do construction work or
Yeah,
whatever. So yeah, payroll. It's been a pressure from a wage standpoint. Fortunately, we just play in the majors in Texas. We don't have a bunch of stuff in kind of some smaller secondary markets.
yeah,
That's where I think that's more exacerbated because there's so many people here, and then we have an in-migration of folks and Texas across the whole, Florida as well. So the Sun Belt states really are seeing the immigration. But if you're in an MSA with 50 to 100,000 people, that's a bigger problem than being in Dallas Fort Worth with 7.8 million people. There's a little bit easier to kind of do that. We have some size with our scale within the management
hmm,
company that we
yeah.
use. So that size helps and matters. Where if you're kind of a one-off mom and pop or smaller, it certainly can become a little bit more stressful.
Refresh my memory. Do you guys are you vertically integrated as far as the management, or is it
No,
outsourced?
we employ a third party management company
Okay,
that we're about a third of their business, give or take.
got it.
So, but they manage about 20,000 units.
So speaking to those challenges as exacerbated in those secondary, tertiary markets, so it allowed me to pivot into that next question. Is it seems like just even over the last couple of years, not just in the past year, but last 3, 4, 5 years. I mean, multifamily has been a hot space for new sponsor syndicators, investors to dive into. And it seems like this seemingly played out in a very similar manner prior to the last crash, or as we led through like 2005, 6, 7. Folks had to start pushing out those primary markets into those more secondary, tertiary markets to chase that yield. And ultimately, that leads to some additional challenges. One being what you just mentioned, when it comes down to finding contractors, staffing, what have you, a little bit more challenging to do that in a tertiary market in Texas than it is in Dallas or San Antonio, one of the other major markets.
Sure.
What are some of the other risks associated with investors? More specifically, newer investors that are getting into the multifamily space that are, again, they don't want to compete against the Michael Beckers of the world, right? Because they're
Sure.
going to get outbid, and so they feel it's necessary to venture off into those, again, the smaller secondary, tertiary markets. What are
Yeah, I
some of
mean
those other
they're
risks?
chasing the yield as you mentioned, trying to get a better return for the dollars invested. But there's different levels of risk as we mentioned about the operational side. But on top of that, I mean it's just a smaller market. You don't have the dynamic population movement into the market or across the market like you do in a major metropolitan area. In Dallas, people are moving all over in and out of the market as well as across the market. So you're constantly having different levels of demand drivers for your tenant base. You just simply don't have that in a smaller market, one. And then two, the income level just isn't there as well
Yeah.
within the overall economy. So some of these people will come in with this mentality that hey, I can do a deal in Dallas or Tampa or wherever. I can buy a property, spend 7,000, 8,000 a unit, and raise my rents $100. Well, there's the income level to support that in Tampa that there
Mhm.
might not be in some smaller secondary market in Florida where they just can't afford to pay that extra $100 a month. So you might be spending $7,000 or $8,000 and only getting, $30, $40 in rent, and increasing your vacancy and your time on the market. So your vacancy loss goes up just because they don't have that income. So trying to match the business model to the demographic within the area. But, with that said, if you can find a market that no one's really gone through and done the value add, which is, probably impossible to do today anymore,
Yeah.
because every deal's been value added at some
Yeah, tell
level.
us which one that is, Mike. Come on,
That's
please.
the unicorn that's out there, right? And maybe that might be more likely in the smaller market. But, if no one's really gone through and done that, maybe you will create some demand that's not there. But it's just not as a proven of a business model. So, there's certainly a little bit higher level of risk within that kind of space.
What are some other big you talk to? I'm sure you probably have folks reach out to you all the time. They're looking to get into the space. I mean, what are some of the other mistakes that you're seeing? Common mistakes that new syndicators diving into multifamily space, aside from maybe investing in the wrong markets. What are some of the other big common mistakes that folks are
I
getting
mean, I
to
think
that?
the biggest thing that I've two things come to mind that I did when I started out. One would be we never made any like fatal mistakes, obviously, or anything overly critical, but coming in slightly undercapitalized. If you need to get that extra 100 grand or not get that extra 100 grand, and what does that do to your IRR? Maybe it moves it, a couple basis points or 20 basis points. You're really trying to make your reputation. You might kind of limp in a little short, and then everything just becomes a little bit harder when you're tied on cash. So coming in a little bit undercapitalized, that's certainly it. Or some of these people overcomplicate the capital stack, and they put not only debt at a higher leverage, they put preferred equity or mezzanine financing, and then they kind of layer it in where you kind of gotta execute to perfection. You don't have a lot of margin for error, or you start getting yourself into some trouble. And then the single biggest mistake I made, which I don't think is quite the same risk today as what it was when I got started, was we took a lot of long-term fixed rate mortgages that had yield maintenance or defeasance prepays on them, and thinking that the rates were going to only go up. And then, of course, the rates went down. And what I thought would be an asset to my situation really became a liability, where you have these large prepays that you had to either sell the loan sell the property on a loan assumption, or pay off a big prepay, which eats into your net proceeds. So, maybe misaligning because they think it's safer and more secure to take a fixed rate, which, in theory it is, but they don't quite understand the concept of yield maintenance prepayment penalties, which I didn't quite fully grasp that whole. I mean, I knew it was there, but just saying it's one thing to know something, and it's another thing to experience it. And you get different level of understanding between those two different. Seat knowledge and book knowledge are two different things. So living through that is a different thing. So maybe mismatching the loan a little bit with their business plan has been a mistake that I've seen made and have made myself personally.
I think that's a big one. Yeah, we've got a few loans right now on the books that again 4 or 5 years ago it seemed like the best fit for that property, long-term fixed rate debt. What was a great rate 4 or 5 years ago is seemingly not a great rate today at all, and just very mismatched the debt with that property and really the long-term vision for that asset. And what have you done to pivot here over the last couple of years once you realize that mistake? And now how do you pair the correct debt with the property from the get-go? What does that
So we've been
process look
taking a
like?
lot of, I mean, there's certainly a time and place for fixed rate mortgages longer term, but we've been taking a lot more floating rate mortgages. The Freddie Mac floater was all the rage for the last couple of years, and then most of this year, 2021, a lot of the debt fund market, so the bridge lenders have been kind of a little bit more active than the Fannie and Freddie have been, and now Fannie and Freddie are realizing they're behind, so they're coming back in a big way. So it's always ever evolving. So we've been taking a little bit more adjustable rate mortgages, and then implement the initial business plan, and then maybe if we decide we want to sell it or if we want to own it, we'll fix it. But maybe I'm only going to do a 5 or 7 year fixed rate, Kevin, instead of a 10 or a 12. So it kind of shortens the maturity of loan and shortens the prepay. So if I say, hey, I want to sell it 4 years on a 7-year mortgage, that's a lot less of a hickey than 4 years into a 10 or 12-year mortgage where that prepay is materially larger.
What is the long-term plan with most of the assets that you acquire? I mean, do you have different sectors of that plan, as far as like some are going to be shorter term holds, 3 to 5 years, some might be 5 to 7, and others might be decades plus?
Yeah, every deal is kind of stands on its own. But yeah, generally speaking, the stuff we're buying, we started out buying older vintage, more of the heavier value add, and kind of over the years sold a lot of the older stuff and traded up on newer, nicer, better, bigger. So we're buying 3 deals right now. All 3 of them are straight from the developer. So we're buying brand new Class A
Wow.
stuff because the cap rates are all basically on top of each other. So for us, it makes similar amount of sense to buy something new and pretty as it does old, because you're getting similar cap rates. So you kind of give up the value add as much, but you don't get all the recurring, capital items you have on these older deals, and you don't get the execution risk of actually having to go implement the value add. And your debt terms tend to be a little bit better on some of these nicer, newer stuff as well. So the math is pretty close, and that seems to be makes more sense to us in our business model today. And that wasn't the case a few years ago. And only thing I learned through this business is everything's always changing. So you talk to me in 2 years from now, I'll probably have a different spin than what I'm talking to you about right now. So that's kind of really what we've been kind of focusing on. But the stuff that's newer, nicer, better, bigger, those are more likely to be something I want to own a little longer period of time. Something's kind of older and functionally obsolescent, you're all having all these repairs and maintenance and lower demographic with an antenna profile, and those are things that we tend to maybe want to get in and out of a little bit quicker. So it just kind of depends on the asset. That's kind of the thought process behind them.
Can you share any details on the three new developments that you guys are acquiring, as far as like cap rate, effective cap rate that they're selling at, what that debt structure looks like going in, and just
so we do two ways we raise capital, Kevin. We've kind of probably focus on one is we'll do syndicated capital, very similar to probably what you do, and most people who listen to the podcast space, kind of $100,000 minimum, raise capital, syndication style. That's probably 60% of our business, maybe 70% of our business. And then we have a pretty meaningful chunk where we do a lot of 1031 work. So we'll help people that are typically out of the area, wanting to come into Texas by multifamily. They sold a building in California or whatever, and they want to come to Texas, don't know anybody. So we'll form a tenant in common or TIC deal with them, them and us, and we just do a deal, get home on the 1031. So we're buying a property in Austin. I got the deal basically awarded in late January, kind of when it came on the radar screen, agreed to buy it in early February. And if you recall, there was a big snowstorm, ice storm that came through Texas in early February. And that was right around the time we were getting this deal put together. And I agreed to it. The cap rate was pretty crappy. I don't remember what it was, around a 3 on a trailing. But the story of the deal was it was in a redevelopment area where they redeveloped this whole old mall and put in a big community college, Austin Community College, consolidated the campuses into this one big this old mall, and it's right across the street. It's a few apartment complexes and restaurants and things like that. And so it had a lot of concessions, and those concessions was like a concession burn off play. So the pro forma cap was reasonable for Austin, which is one of the hotter markets in the country. And so it was a basic investment thesis. And I remember touring my equity partner when the Saturday after the ice storm, so there's still ice on the ground, it's kind of thawing. And Texas, it seems like ever since the ice melted, the market got white hot. So basically the last three and a half months as we kind of record this now, the market's been insane ever since that ice storm kind of hit. And that was really kind of the moment. We got this deal tied up right before. So I swear to you, we're probably, we're closing on Friday. So we're, a couple of days as we record this, the deal's probably up 20,000 a unit, and we haven't even closed it. Wow. So it's just amazing to see the inflow of capital is just insatiable. Like the amount of money chasing Texas multifamily is, and all varieties, right? Workforce housing to brand new Class A, core, suburban, tertiary, whatever. On any segment you can think of, the amount of capital is obscene that is coming into the space right now, and it's really driving cap rates down and pricing up. And so we got this 5 minutes for the world just caught on fire is what it seems like. And that's been 3 months ago. So it doesn't even seem, it's not really been that long in the grand scheme of things, but it's been nuts to kind of see this come. So that was kind of the play, and our partner, had a big gain in their exchange they did. So they were looking for like more of a preservation play. Mm-hmm. The other two deals we're buying in San Antonio. That is our first two deals in San Antonio. We've never historically been there, and we think it's a pretty good time in the market. If in looking at San Antonio, it's kind of the sister city to Austin. They're about 90 minutes from downtown to downtown, down 35, I-35 from each other. And San Antonio and Austin are basically the same size market from a population standpoint, as well as they have very similar total multifamily unit counts in both markets. So they're all intents and purposes the same market from a size standpoint. And over the last several years, the builders have been building and delivering about 6 to 8,000 units a year in both San Antonio and Austin. Well, Austin's been able to absorb those. San Antonio got a little sluggish in supply, and supply kind of built up. So there was concessions and higher vacancy and things like that. Well, the developers realized that, and they pulled back the supply in San Antonio, and they kept going in Austin. So you look right now, San Antonio has about 5,000 units under construction. Austin has 22,000 units under construction, and they're basically the same size. So we feel it's a good time to enter San Antonio because now the submarket, generally speaking, all the markets are, submarkets are 95%, and all the concessions are basically gone. And the supply pipeline is, fraction of what it was in recent past. So we think it's a good time to enter. So we're buying a core deal and we're buying a suburban deal, both brand new Class A deals from the developer. And we think, and the prices is you probably get a 50 to 75 basis point higher cap rate in San Antonio or Austin. And that's probably translating into, a third to maybe 40% cheaper in a per door basis on a model match property if you just picked it up and moved it to a similar market in Austin. Wow. So it's probably that my recollection has never been wider, the disparity between the two markets. So we think it's probably better, a pretty good time to enter the market. And that's really what we're focusing on. And maybe even 2-3 years from now, it might not be, but I think it is right now.
Yeah, great. So is the net migration in Austin, is the forecast of net migration here over the coming years strong enough to support, 22,000 new doors coming online?
Let's hope so.
Okay. No, I'm wondering. I mean, you've obviously got the data, so I'm wondering what the data says.
No, I think it is. I mean, they've pretty much been able to, with the market's been pretty much at equilibrium in the grand scheme of things. Sometimes, swings on the other side of equilibrium at any moment in time. But yes, generally speaking, it is. And then, there's across the country, and Austin is certainly one of the leading culprits in it. The for sale single family is, next to impossible to buy. It's like 0.4 months of supply in Austin right now. It's, next to impossible to buy a house down there. And then the people that are moving in are, high income earners, a lot of tech jobs from the Bay Area. So I think, we mainly play in Dallas-Fort Worth and Austin is really the two markets we focus on. And so the way I kind of compare them is Dallas is turning into Los Angeles and Austin is turning into San Francisco kind of right before our eyes. It's probably just 30 years ago in those two different markets. And so that's kind of what's going on. So Dallas is bigger and more diverse, and San Francisco's, and Austin's more tech and government and a little bit more of a high flyer of the two markets, but they're both, they're both growing.
Interesting. So what asset classes outside of multifamily are you bullish on, if any? And
sure,
the better way to position that question is outside of multifamily, which you have your own capital into as well. Where else does Michael Becker put his money?
I think what the consensus is sheds and beds, right? Industrial housing, those are the two things, and maybe a little bit of the others. Not industrial, not retail, not hospitality, not office. So you get some of the medical stuff and some of the data centers, I think, are attracting capital. Mm-hmm. So that's kind of the consensus play. I don't really invest in a whole lot besides real estate, because every time I do it, I've invested in oil, and every time I do it, I lose money. So I've kind of learned that to do that. My buddy Dave Zook, I don't know if you know Dave Zook or know Dave Zook. He has an ATM fund. I've done that 5 or 6 tranches, and that's the only thing besides apartments that is actually paid off, and it pays off like an ATM, right? You just go and pull money out. So that's worked reasonably well. And outside of that, I just kind of tend to sit on some cash and that's like gold stocks and crap like that, because I think we're going to see some, price inflation in commodities, which we certainly have seen here in recent past. So at some point, I would imagine the gold and silver goes up, but I've been sitting there waiting for that for a while, so it hasn't quite happened yet. But I really just focus on the same thing, and I really pretty binary, either have risk on my money or risk off my money. And so I want to make sure my money's safe, and then when I'm ready to go put risk on it, I want to make a big return. And so that's kind of what I focus on. And I found in my life it's better to invest in something that I know and understand. And apartments have always done well.
So I'm guessing you're not a crypto guy then.
I'm not a crypto guy. I feel bad because I saw it when it was first learned about it when the Bitcoin was like $10 or something, over a decade ago. And I didn't see it then, and I certainly don't see it at whatever price it is today. And it moves 7% a day, so it's kind of hard to pick a price.
Yeah, no, it's funny. I feel like I at least want to understand it, but I haven't been able to understand it, and so I haven't invested any money into it.
That's right.
So, and watching it jump up and down, with volatility, it just it tells me that it's probably not meant for me. I just don't really have the stomach to watch that roller coaster ride up super high and then dip super low. It's just too many other things that I want to focus on and not be stuck on the screen watching what the price of Bitcoin is doing on a daily basis. So in any event, Michael, pleasure coming back, buddy. I'm really always excited to talk to you and catch up with what you got going on. For folks that want to learn more about you and what you have happening and get signed up on your list, I know that you guys put out new investments on a regular basis. Where's the best place to find you?
I'll give you two resources. So I'm the co-host of the Old Capital Real Estate Investing Podcast. Been doing that for many years. So you can find that on iTunes or Stitcher, or probably anywhere you hear my voice right now, or you can just go to oldcapitalpodcast.com and you can find that there. And if you're an apartment nerd, it's kind of the place for you, right? We talk about multifamily. And then the company I run is SPI Advisory, which you go to our website, which is www.spiadvisory.com. It's SPI like spy advisory.com. There's a contact us form, fill it out. Always happy to send out some information about potentially working with us.
Good deal. Michael, always a pleasure, my friend. Thanks for coming back.
Thanks, Kevin. Appreciate it.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Buff, wishing you huge success. Take care.